Hello, and welcome to another episode of White for Life. Tonight we are continuing the discussion of the home ownership series, and we have returning to the White for stage our guest from last month, Arlene Deveaux. Last month she talked with us about wise borrowing, and tonight we're going to talk about understanding your home mortgage and home financing options. A lot of people are interested in how to finance a home, how to be in a position to afford a home, to know what it is that they need to do to get ready to prepare to own a home. And so we're talking all of the finances tonight. And so a little bit about WIFER. WIFER stands for Wife Healed, Empowered, Restored. We are a community of women for women, and we seek to help women become her healed, empowered, restored through providing continuing education opportunities like lives and our social media postings and our curated events. And so welcome Arlene, welcome back.
Thank you.
And for the benefit for the benefit of our viewers tonight, I'm going to read your bio. So Arlene Deveaux is a young professional with 15 years of banking and finance experience. Being born and raised in the Bahamas, she started a career in banking that led to a relocation to the Turks and Caicos Islands. Over these years, Arlene has developed various skills, including those acquired working in collections and also as a mortgage specialist of residential and non-residential financing. Most recently, she shifted gears and is focusing on a new career path in anti-money laundering. However, she is also an entrepreneur and is the founder of Kiss and Makeup Beauty Parlor. Her future goals include expanding her portfolio of work, education, and coming up with solutions that will benefit her community and impact the world, such as going live on YouTube with information. So, welcome again, and thank you so much for agreeing to come on to share your knowledge with us. We had so much fun last month, and so it
Yeah.
only was fitting that we come back to talk this month.
Yes.
So, I'm going to put your slideshow up.
Yes. And I guess we could start. So tonight's topic is here, understanding your mortgage and home financing options. Tonight, I'm going to be providing a lot of real life kind of scenarios in terms of the amount of earnings versus how much a person can qualify for. Zemi is going to kind of guide and insert any questions that may come up along through the discussion. And then we'll have like major questions at the end of the presentation, like last time. Okay. Okay. So basically, just going to briefly go over the qualification process. So, what do I need? When you're approaching any bank or financial institution, you're going to need a few basic things in order to qualify or obtain a pre approval for mortgage financing. Okay. So, the first one we have here is a job letter, which confirms your weekly, bi weekly, monthly, or annual salary, your tenure with the company, and your current role or position. Okay. Of course, tenure means how long you've been working with the company. The next item is 3 most recent months pay slips to confirm your salary payments. The next one is for non-residents who seek to qualify or pre-qualify. They will require 3 years of tax returns for income verification. Okay, so that's the difference between the local borrower and a non-resident borrower in terms of what they need to qualify for their income. You need a utility bill confirming your address. If you don't have a utility bill in your name, you need authorization from the person who you reside with. So that is done virtual through a letter with that person signing off and attaching the utility bill with that saying that you live with them. The last one is two valid government identification. Passport is mandatory, and then along with another ID like a driver's license or voter's card. In the Turks and Caicos, is a Turks and Caicos Islanders card, your national insurance card, something like that. So those are the basic items you would need when coming to a bank to get pre-qualified. Next. Okay, so what should I consider first? Here's a few things that I think that the individual needs to consider before they come to a bank, right? So you should consider how much you earn on a regular basis, whether it's weekly, bi-weekly, or monthly. How much do I save on a monthly basis? How much do I spend on monthly bills? And how much funds do I have left to spare? These questions basically kind of let you review your own financial position to say, okay, how much money do I have to spare that I could actually commit to giving to a financial institution every month and do not miss it, really and truly, right? So you're basically trying to say, based on the actual funds that you make every month, how much you can afford to sacrifice, basically.
We do have a question on the pre-qual. I know we're gonna have a lot of questions about this
I know.
scenario, so let's get the pre-qual question. So from
Okay.
another country, would you need both check stubs and 3 years of tax returns? I think this is a US, from a
Ye-
US perspective. Yeah.
but you would only need the 3 months. But see, in the US, okay, in the US, it's kind of different because the W 2 document is your confirmation of your salary income. It's like a pay slip. So we would ask for your W 2 document along with 3 years of tax returns, the most recent 3 years tax returns. So that's kind of different than with I mean, we still require a job letter, but in terms of verifying the income from the employer, it's the W-2 and the tax returns.
Thank you.
Okay. So this is an example of someone that would earn the minimum salary requirement that the bank, requires an individual to earn to borrow money. So if you don't make $24,000 a year, you may not be able to qualify for a facility at the bank. Okay, so I have here in red though, I have done all of these examples that will follow based on one interest rate, and that is 6.25%. 6.25%. I chose that because it's not too low, it's not too high, it's just an example. The amounts may change based on the rate, but that is the rate I use. Okay, so someone making $24,000 a year is going to make $2,000 a month. Based on the policies from the bank, the maximum amount that someone should be paying to a financial institution or a bank is 45% of their monthly income. In this case, 45% of 2,000 is $900. So that means any loans, credit card payments, or anything that you borrow from the bank should be at a maximum of $900 or 45% of your monthly income. Okay. I put a conservative debt amount, which means, this should be kind of where you want to be in terms of borrowing from the bank. You don't want to have almost half of your money going to the bank every month. But a conservative debt amount should be about 30%. And this is my personal recommendation. Okay. So based on this, a mortgage for this particular person, if they're like, let's say in the Bahamas, we have low cost homes that may be $100,000 or less. This person can qualify for an $80,000 mortgage with payments of $527.74 at a rate of 6.25% for 25 years. And of course, the 25 years will be based on if the individual is, will be 65 at the end of their mortgage facility. If the person is older, then the term may be less, and that means the payment may be higher if this rate is the same. I don't know if you have any questions from that basic example.
Not yet. Not yet.
Okay. Okay, so the next one, we're just doing it in increments to show the difference, right? So the next one is kind of like an average salary, 28,000 per year. This monthly salary is $2,333. Of course, this is gross. Okay. Everything that the bank calculates is based on your gross salary, not your net salary. The maximum debt allowed, again, 45%, which is $1,050 in this case. The conservative debt amount I'm recommending is $700. Okay. So in this case, the maximum mortgage based on the rate, which is 6.25, would be $136,000 with payments of $897.15 for 25 years. Now, I suggested this, and if anybody else does the calculation, right, technically, this person can get a little bit more, but realistically, everybody might have at least one credit card or want a credit card or need a credit card. So I made provisions for the credit card, which includes the payment of 150. So when you add 150 and 897, that will fall within the 1,050 maximum debt allowed for that individual. So
Mm-hmm.
as you can see here, right, this is the maximum that this person can qualify for and be able to have whatever, disposable income and move forward. And I want to stress here, when you make a commitment to the bank for 25 years, you hear the amount of years, right? This is like 25 years.
Oh
It
yeah.
is expected that nothing will change unless you have a variable rate. Your payment may decrease or increase. And this is the issue with the maximum debt allowed, because if the bank lends you up to the 1,050 and the rate changes and it increases, you can no longer afford your payment. And so these are the things that your banker and your financial planner or whoever you're discussing your finances with, they have to consider all of these factors, because the market is very volatile at this point. The rates are going
Mm-hmm.
up and down, up and down. And so these things have to be accounted for, or you won't be able to afford your mortgage. Okay. Next one. This one is for someone making 36,000. Okay, obviously the amounts are going to increase. The monthly income is 3,000 gross. The maximum debt is 45%, which is 1,350. And so based on this particular person leaving the credit card at 3,000, which is like a minimum, right? The maximum mortgage that I would recommend is 200,000 with a payment of 1,319.34 at 6.25% for 25 years, with a credit card of 3,000 and a minimum payment of 250. Oh, okay, sorry. This one, I did two examples. So the maximum without a credit card this person can get is 200,000. Okay, if they don't have a credit card and they just want to get a mortgage, they can get 200,000 and the payment would be 1,319. But if they want a credit card of 3,000, they can get a maximum mortgage of 184,000.
Mm-hmm.
Okay. I think I made a mistake with the minimum payment, because the minimum payment should be 150 for 3,000. Okay. So that is what this person would be qualified for, 184,000, and the payment would be 12,1379. This is at 6.5%. I'm stressing that again, just at that amount. If you have a lower rate, the payment would be lower and you would have a little bit more flexibility, but it won't be crazy lower. It's going to be like $20, $50 difference or something like that. Okay. So I did it for 40, 50, and 60, just so you could snapshot if you fall in this category. This is a snapshot of what you would qualify for if you have a minimum credit card of 3,000 and the minimum payment is 150. Now, a lot of people have more than one credit card. A lot of people have personal loans. I did not include the personal loan. But if you do have a personal loan, you would have to include the payment. And I will speak about that a little bit later with another breakdown that I have of your finances. Okay. But these here are the various amounts that individuals may qualify for based on their income and based on the rate of 6.25%. I'm not sure what the banks are offering at this point. I know we had a pandemic. Banks are trying to recoup funds that were lost. A lot of people lost income. So I can imagine that the rates are probably going to start to be a little bit higher, depending on, the bank's situation, really and truly. Any questions?
No, I think it's just good to call out. So if you make 40,000 and you're thinking about a
Okay.
max mortgage, 200,000, 50,000, 256, and if you make 60,000,
Yeah,
you comfortably be able to afford $308,000. So that gives people things to aim for, things to consider when they're searching for a home. So
right.
you know that I shouldn't be in the $600 house range because I can't afford that much house based on my income and the debt that I have. So maybe I need to look at these listings in the category I can afford, distressed properties, etc. So it sets your expectations up
Right.
front of what you should be looking for and what you should qualify for.
Yeah. And so that's why I have the 45%, because no matter what, that is a maximum on that income. So that is the maximum your payment should be at, is at 45%. So what you're looking at is the payment is going to be more than your 45%, you automatically cannot qualify for that particular home.
And then some people say that even your home insurance, your HOA fees, all of that should come under that 45. And some people, you said 30. I mean, I saw another calculation on Instagram and she said 25. So it depends on how much risk and how much debt you personally want to have as an individual. And you need to
Exactly.
know these figures going to change if you add in more expenses that come in your 45%.
Yes, because in the United States as well, they include all of those things within the mortgage payment.
Mm-hmm.
So they have an advantage because their rate will be lower, but because of the HOI fees and other little fees like that is included, it will bring it up to this kind of payment in reality.
Yeah.
So you could go to the next slide. So, okay, so I just have this little point here that the cost of money changes frequently. The maximum amounts provided in the examples are not going to change. However, the amount you may be able to borrow may increase or decrease based on the cost or interest that the market dictates at that time. And that's what I was basically saying already, that based on your rate, if they offer you a 5% rate, then you already know that the amount that you can borrow will increase because the payment will decrease. But now you still have to bear in mind that if that rate is to increase, then you have to make sure that that's going to fall within your 45% because you can stand the risk of, not being able to make the payment. And
Mm-hmm.
these previous examples were done on individuals who might want to get a facility on their own. It can be a combined income as well because it's the same thing, the same calculation. But I do have an example later that does a breakdown for two individuals. Okay, so what do we forget? We forget how much disposable income we have left when we are committing to pay a mortgage facility for 20 to 30 years to a bank or financial institution. So a lot of times we go into the bank, we're only thinking about what it is we want. So you think about the car, you think about the house, and you only want to know how to qualify. But I really wanted to talk about the other side that people forget, and you only remember it when you can't meet the payment or when something happens.
Mm-hmm.
Okay, because everybody wants to know, how do I qualify, how do I get this money, oh, what I need to bring, all this stuff. All that sounds good, but what do you have left? What do you have to pay your bills, take care of your children? So let's go to the next slide. We're going to talk about that a little bit. So it's a little bit small. You may not be able to see it, but disposable income is what we're going to talk about right now. Okay. So this is the remainder of your monthly income, which takes care of the rest of your other expenses and commitments. For example, for Christians, tithes, your savings, rent, utility bills, daycare and school fees, food, gas and transportation, clothes, shoes, your basic necessities, and other miscellaneous items like hair, nails, makeup, cologne, perfume, all these things that bring us, our basic pleasure and satisfaction.
So that means your 55% has to cover all of that.
The rest
Wow.
is to cover all of your other bills. And I think we tend to forget that these bills are also very steep.
Mm-hmm.
Now, when you're getting a mortgage, the rent amount is going to be deducted from the calculation because it's expected that you won't be paying rent anymore. You're going to be paying a mortgage. So when they are qualifying you, they take into consider what the rent is going to be, but they remove the rent from the calculation if you're going to be purchasing a home. Now, when you're
Mm-hmm.
getting a personal loan or credit card, your rent is included in your debt servicing. Okay, so your primary residence, that expense is always included. Okay, do not overextend yourself. So this is kind of tiny, but I hope you're going to be able to follow. This is a snapshot of expenses before you decide to borrow. So the first column is an individual making 36,000 per year, which is 3,000 per month, which we established. Okay, so I kind of calculated a net income of about 2880. It could be within that range. It may not be exactly that. I just deducted national insurance or national health insurance for us who live in the Caribbean. All right. So the expenses that I listed before, if you take these away, that's what the brackets mean. You take away your 10% from your 3,000, which is 300. And in this case, I'm saving 10%, which is 300. The rental payment is 900. Light, your electricity, 150. Water bill, $50. Cable bill, $90. Internet, $95. Food, which I was very conservative in saying $100 a week. Gas or transportation, $120 a month. And when you deduct all of that, the balance you have left now is $475. This is if you're going by your gross monthly income and you're only operating with the funds that you actually earn per month. Okay? The balance, your disposable income balance is $475. That is realistically what you would have to spend if you're a person who are living on your own, currently renting, and looking to purchase or looking to get anything. This is realistically what you're looking at. And of course, I did not even include miscellaneous expenses that will be deducted from that and could be anywhere between $200 and $300 a month. You realistically only have $175 if you look at it at the end of the day, right? That's outside of your regular savings. The second column, I did a breakdown of a perfect world, two-income households of a total of $67,000 per year. And realistically, everybody doesn't make the same. So one individual is earning $36,000, which is $3,000 a month. The second individual is earning $31,000, which is $25.83 per month. The net income with both incomes combined is $53.60. And of course, as you can see, with a two-income household, you have more purchasing power, more saving power if you work together. Okay, so let's deduct these expenses for each individual that I have here combined and showing the amounts. The tithes total is $558. Savings, if you save together or separately, your 10%, $560. Rent, which is divided between two people, 900. Light, of course, it's going to be a little bit more with two people, so I put 200. Water would be 80. Cable, 90. Internet, 95. Food is going to be double because it's two people, $800. Gas and transportation is $250. And your miscellaneous expenses, which I decided to include this time, is $800 with $400 per person being able to spend whatever they want. The balance of that disposable income is $1,027. And as you see together, this is, an advantage, right? Now, if this couple decide that they want to purchase a home and they're actually committed to this goal of purchasing a home, I have a note on the side because the following slides is going to break down certain things. So if this couple decides they want to purchase a home, they can save $100,000 in 5 years, right? But this takes a lot of commitment, a lot of discipline, because when you do the calculations, $100,000 in 5 years is $20,000 per year. To save $20,000 per year, you need to save $1,666.67 per month. And of course, this is only in the event that you have no other bills that is listed here. Like if persons who have kids, obviously it will take a little bit longer. I didn't bother to do the calculation just because this is just for argument's sake. So this is a couple, a newly gotten together couple with no children. Like I said, in a perfect world, they would be able to save at least $1,670 per month to able to have the down payment and closing costs for a mortgage. Because I'm going to break it down in the next slide and as to the certain costs that are associated with purchasing. Okay, so here's a tip. If you live with family, this individual may somewhat have a slight disadvantage because there's not much proof that he or she is responsible to take on a facility like a mortgage. However, your financial position will be better, especially if you save a consistent and significant amount every month. By doing this, you're not only covering your down payment obligation, but you're demonstrating that you are committed and will be a great loan or mortgage client in the future. You have a clear advantage to save most of your monthly income if you remove the expenses of the living on your own, like I did on the breakdown. So if you don't have any other responsibilities, but you're making this kind of money, as you can see, you have an advantage and you can save a significant amount of money in a short amount of time to be able to, achieve your purchasing goals. So the down payment and closing cost breakdown, of course, this is kind of based on TCI, Turks and Caicos, but these fees kind of apply everywhere and they may be called something different, but I have it outlined here for you so you could really see, what the costs are. So at the top here, this is the formula for calculating the actual amount that the bank is willing to finance. Well, the actual asking price and financing amount. Okay. So the asking price minus the cost of furniture, which is normally 10% of the asking price, is your net asking price. So if you view a home and it costs $250,000, the bank is going to minus the cost of the furniture, which is $25,000. So now your net asking is $225,000. The down payment obviously is going to vary based on which banking institution you decide to bank with. So of course I made that note. Down payments can range anywhere from 5% to 20%. Okay. And for argument's sake, we're going to do the 20% in this example. So your net asking of $225,000 minus $45,000, which is your 20% down payment, equals $180,000, which the bank is going to be willing to finance. Okay, so that is going to be the mortgage amount in this example. So your mortgage is going to be $180,000, and as you can see, down payment and closing is highlighted at $92,725. Okay, and I've broken down everything. Everything with an asterisk obviously is an amount that may change. Okay, so the 20% is $45,000 plus the cost of the furniture, which you now have to find, whether it's by a loan or you have the cash to purchase the funds. And that's only if you desire to purchase the furniture that comes with the home that you are going to purchase. Okay, so if you're not going to purchase the furniture, you can minus the 25,000. It's going to be about 60 something thousand you're going to need. Okay, the legal fee is $1,800. Stamp duty for this amount, 6.5%, which is $11,700. Stamp tax is 1% of the mortgage amount, which is $1,800. Notary fees, it may vary. It may be less, but maximum is going to be $250. Delivery and other miscellaneous fees, we just have there at $175 just in case. The bank fee, 1.5%. This can also vary as well. We have that as $2,500. The homeowner's insurance, this may vary depending on what you're purchasing. If you're purchasing a condo and it has strata insurance, you're not going to have to worry about this part, but you will pay your strata with the particular place that you're purchasing the unit from. But anyone else would have to ensure that they have homeowners insurance and it's insured before the bank even, releases anything to you. You have to ensure that it's paid. Okay. And then of course I included the appraisal because this is also a cost associated with the purchase. Now, when the bank advises you about your closing costs, they don't normally highlight your homeowner's insurance and appraisals. They don't normally include this in your agreement. So some of these fees will not be highlighted in your agreement to say, okay, you have to come up with these. But these are all of the costs that you can think of that would be associated with purchasing a home. And I've highlighted all of these here. And of course, like I said, they're all subject to change. I'm not sure about insurance quotes, so I just put an amount that seemed that it might suit this particular home. It can be more, it can be less. I'm not exactly sure. Okay, but this is a realistic look at the type of fees that you're going to have to come up with. Okay, the percentage are consistent, but the amounts will change based on what the mortgage amount is. So obviously, if the mortgage amount is increase, 1% of an increase amount is going to be more. Okay. I don't know if anybody have any questions there, because I know I went through that a little bit fast, but those are a lot of
Not
costs
not
that,
necessarily questions, but like a comment. That amount, that's your down payment and closing. That was 92,725.
yes,
That was
it's real.
like half the mortgage.
It, it's real. It's
So,
real.
and someone says, "Oh, wow, this is good information." Puts it all in perspective. So
Yes.
I put this back on the screen. So you would think that you in a good position to afford it, but then you have to make sure that you actually aren't just saving up so that you can afford your monthly payment and your down payment. You have to think about all the associated costs as well. And so it is a good
So
idea to think about doubling. Yeah.
this is the
Go ahead,
cost you have
sorry.
to think about before you even come to the bank. And maybe
Mm-hmm.
not all of it, but realistically, if you're considering purchasing the furniture that comes with the home, a lot of people don't do that. But if it's a condo, you're gonna probably purchase it, because if it's a brand new condo that has just been built in the last few years, you're gonna want the furniture, and so you're gonna pay for it. And so this is something that's gonna be realistically included in your costs that you have to come up with. And this is the reason why a lot of sales fall through, because people start off with their 20% only.
Mm-hmm.
Oh, we have our down payment, we're
Mm-hmm.
ready to purchase. No, you're not, because there are legal fees there. You have to pay for an appraisal to make sure that the value, the market value that you are saying that it is, or that you're willing to pay for it, the bank has to ensure that the collateral matches the cost that you're trying to pay for it, because they're only going to finance based on the actual market value that's dictated in the appraisal. If the appraisal comes back less, then they're going to finance less, because they're going to use the market value that's outlined in the appraisal and do the calculations from that. So that's another thing that has to be considered, because that's happened to people, maybe not a lot, but it's always best to get an appraisal first before you agree on the price. But then at the same
Mm-hmm.
time, it's a cost that you incur. And if it falls through, then you lose the money. Now, the
Yeah.
smartest thing to do is, if the seller has an updated appraisal, or one that was done within the last 5 years, you can probably, see if you could find a way to find
Leverage
out or
that.
get access to that, so you can have
At
a
least use
better,
it for information. Yeah.
yeah, because it's going to help you to be able to know, okay, is this a fair price? Because the bank is going to do it based on what the market value is dictated in that appraisal. So that causes a lot of issues as well. A lot of people get frustrated with the banking process, because they say, they keep coming back and keep, things keep changing, but things change because of the process and because of what has to be analyzed before the whole thing is completed. And so, yes, you could
Mm-hmm.
pre-qualify for an amount. Yes, the property can look good based on the listing. Yes, you can have your down payment, but if you don't have your closing costs, and if the bank reviews that appraisal and doesn't think that it's suitable, that's another issue. If there's renovations needed, do you qualify for the renovations? There are so many things that can happen during the process that is very frustrating, that can cause delays. So the more you know, the better you are, really and
Definitely.
truly.
And you said about the furniture, that reminded me of our process. We decided not to put furniture in our mortgage and have purchase furniture over time. But we were in our home for like 2 years and the place still wasn't fully furnished. And so people, if you want a
Yeah.
place where you can automatically entertain family, I would say, let's just bite the bullet. Let's get all our furniture in. But you have to weigh the cost, obviously, and what you can afford if you want to pay for convenience or if you want to stage it over time. So definitely additional considerations.
Yes,
Now
and
go
it
back
also
to
depends
the
on what you can afford, and also if the furniture you're purchasing is actually in good condition. Of course, certain things you don't want to inherit from people, depending on how long or how old the house is, or whatever. So you probably would want to
definitely.
buy new furniture, but you would need to consider that. in the whole process as well. So I try to include as much as possible. I don't think there are any other surprising costs that comes up. There's nothing really a surprise. I think a lot of people are surprised about the homeowner's insurance having to pay that upfront. And normally the insurance company requires the full payment, not no monthly payment, and then they want
Mm-hmm.
the whole amount to be paid. And then you present that to the bank showing that the house is insured in your name and the bank name as the lost payee, and then they're good to go. So you can get to the next slide.
We do have a question.
Oh,
How much different is it for a commercial property?
these are kind of the same requirements that are paid. The difference between commercial property is the fact that you're going to pay a higher down payment. So the down payment requirement is going to be higher. It all depends on the financial institution that you bank with that will dictate that amount. But realistically, commercial property is going to be a little bit higher. So that means you're going to have more closing costs depending on, and everything is depending on the amount of the purchase price. And then the percentages stay the same. But of course, you would have to find that information out from your bank.
That was
So
actually the
that
last
is the
slide.
gist. If we have any more questions, but I just focus a lot more on the examples. Yes, the homeowner is responsible for the closing cost. And so that is why it is kind of difficult for people to, move forward through the process as quick as they think if they're not prepared already. So if you haven't been saving on a consistent basis, on a regular basis before you're looking for a home, it may be difficult to close because all of these costs have to be paid before the home is closed. So this isn't anything where you can make monthly payments or you can do a payment plan. Everything has to be paid before the bank releases the funds to pay the seller. Okay, so a lot of times people can, depend on how much you make or depend on how much you and your spouse or whoever, if you're getting something jointly, and if the process is going to take about 3 to 6 months realistically, and if you have that 3 to 6 months and if it's enough to cover, then you're fine. But you realistically going to need the bulk of that money because you're going to have to pay for the appraisals, you're going to have to pay the legal costs as soon as you sign the contract. You're going to have to pay the legal costs, you're going to have to pay all these things. But of course, at the same time, the bank also checks to see that you actually have this money for the closing costs. Sometimes that is a requirement in order for them to move forward, that you have all of the money for the closing costs. So we don't go through all of this, and then at the end of the day, you don't have the closing costs, you can't pay the legal fees. It's just a waste of time. In the
And she goes to
United
the question, say, would the seller have to pay?
In the United States, is a little bit different. So I think there are times where they can make agreements that the seller can negotiate to accommodate for closing costs. It's a little bit different in the United States. So there are times where the seller may pay for some of the closing costs or whatever, because there are certain fees that, the seller may have to pay in terms of transferring or whatever. So in the United States, it's a little bit different. But in the Caribbean, the purchaser is responsible for closing costs, wholly and solely.
And I have a question. I don't see any more questions, but if you all have questions, this is the time to ask them and have them answered for you. So,
Yeah.
if someone is making a decision between renting and entering into a mortgage,
Uh-huh.
and those two payments would essentially be the same, what are their determining factors to say, should I purchase a home?
Mhm.
Should I keep renting? Why do I even want to purchase a home if I have this debt burden? Like, what would you tell someone if they're trying to determine which way should I go?
Well, I think it all depends on your individual and personal goals. I think owning a home has been a goal for most people, you know, for a whole lifetime. Like that has been the dream. You get your home after you have your career, you get married, you know, the expectations now, you
Hmm.
you know, purchase your home, you settle down. What I find is though, people are changing and our desires are also changing. And so you would find that okay, you might like this house now, but you may decide that you want to move. You may want to move to another
Hmm.
country. You may want to get a job opportunity somewhere else. And so settling down in one place for 50 years is no longer the case, you know? So
Yeah.
I would say the best thing to do is to ensure that you purchase something that can gain you income. So if you if you're renting or you decide you want to rent, but then you also want to purchase, the best thing to purchase is a condo that can be rented out, Airbnb, or a small home that can attract a lot of customers. Like 1 and 2 bedrooms are easy to rent out. And so if you decide on a purchase like that, that's a smart purchase because you can rent and that place can pay for itself, meaning you rent it out either on a long-term basis or short-term basis, and it basically covers for its own self. So kind of it's self-sufficient and you won't have to worry about it. It's a place where you could go if you feel like it. If you decide that you want to settle down, you could get rid of the rent and you can be there. It would have already paid, some of
Hmm.
itself off. So I think smarter purchases where there's an option to rent out the place, it's better, you know, in that
Yeah,
kind of way
especially
for
if you are don't have kids yet. Like my husband and I did the exact same thing. We purchased a townhome. It's 2 bedrooms, 2.5 bath in a gated community. We,
hmm
upgraded some things, left some things as is because we knew it wasn't going to be our forever home. And
right.
we have been able to rent it out and cover the mortgage and associated fees while
Exactly.
we are out of the country, which has been an
Right.
incredible thing.
Yeah.
So you have to think about these purchases strategically.
Yes.
I didn't necessarily, but
No.
it just happens that
Yeah.
way, and so you do need to be strategic and think about what you can afford. My husband
Yeah.
and I love to live below our means instead of at the very edge, and that's how you should be as well because then you can be comfortable. You don't want to
Exactly.
feel like the bank could pull the rug from under me at any moment. You never want to feel like you're a slave to the bank. And so many people are afraid of the bank, as you know.
And that's never the goal. Like the bank never wants to have to take anything back from someone because the bank sells money. The bank doesn't sell
Mhm.
products like stuff. Yes, a credit card is a product, a debit card might be an actual physical product, but the bank sells money. The bank lends you money at a price. And so the bank doesn't want to have to, okay, now we're a real estate company. Now we have to sell a house to get our money back. The bank doesn't really want to do that. And that's why these policies are in place, though, to ensure that you can actually live. The bank has to abide by whatever the country's rules are, which says,
For
okay,
sure.
you cannot have my citizens up to their eyeballs in debt and now they can't afford to eat. And that's why the bank has to say, okay, you cannot qualify because you're already at your maximum. You have to be able to cover your disposable income. And it's very dangerous too for persons who do commit to a mortgage before having children without considering school fees,
Oh
medical
yeah.
bills. All these things are things that
Mhm.
we don't think about because, okay, we're free, we're single, we don't have any children. Let's just buy a place, it looks good or whatever. But when the kids come, it's difficult
Yeah. And
because you're
especially
ready.
with these school fees today, a
You're
thousand
ready
dollars a term, and you have 3 children.
you made
You
a lifetime
know.
commitment and then you birth lifetime commitments.
Hmm.
So you choose your family over the bank's commitment. And then that's where there's a clash. Because at
Yeah.
the end of the day, you're going to make sure your kids are fine, your family comes first, yes. But you made a lifetime commitment with a financial institution for almost half of your monthly income. And
So
this is the dangerous thing.
can I ask my banker to put in like hypotheticals for me as a consumer? So if I go to my banker and I say, put in some hypotheticals and I plan to have kids, put in some hypothetical figures of like $3,000 a year is for my kid to help me determine what I can afford.
You could, but what they would normally do is they will assess your current expenses, your current assets, and your liabilities. So they do include your assets if you already own property, if you already have a vehicle or
Mhm.
land or whatever. They assess it because they have to know what your personal net worth is as well. So your net worth consists of your assets minus your liabilities, and what is left is your net worth, right? And so, I mean, they can include it, but it won't stay permanent on your application to say, okay, these are expenses that this person have.
Yeah.
That's
Mhm.
why something like 30% debt ratio is something that is smart, because that other 10% can go towards, well, 15% can go towards your expenses for your kids and stuff like that. And
Yeah,
then it's
definitely.
also beneficial where there's two persons making a substantial annual income. You
Mhm.
have more flexibility. You can afford to take care of your children without having to, struggle too much. Because even like the example that I showed with the slide for the income of 67,000 with the two individuals, with all of the expenses there, they had a net of 1,027, right? Now, like I said, if they take away the miscellaneous and maybe, some people don't save, but that was like almost $600 a month that they were saving, So if you add, that's
Mhm. Mhm.
1,627 a month. So these people can take care of a child or two, but then there goes the
It'd be
mortgage
tight.
money, right? It'll
Yeah.
be it will be right. Now the rents can substitute for the mortgage depending on where they live and the price point, and if they can find something that's affordable, they may be able to have a mortgage and take care of their kids fine without stressing themselves out. But it also a point I also want to make is managing your household bills, because I feel like your monthly bills should be stable to the point where you know what your bills are kind of going to be. Like, for sure, your internet bill isn't going to change. Cable bill probably isn't going to change. But your water bill and your light bill are bills that you can control. You can cut off the lights if
Mhm.
you don't need them.
LED
You
lighting.
cannot
Yeah.
run extra water, waste water that you're spending a lot more money
Time
on.
heaters. Yeah. Mhm.
Certain things you can do to reduce your monthly bills and keep them at a maintained amount, especially if you're trying to save towards a goal. I know a lot of people, they don't want to nickel and dime themselves pulling out plugs and stuff. Some people don't like to do that. But if you have a goal in mind, you want to make sure your monthly bills are as low as possible. Spending extra money on food unnecessarily. That's stuff you could check yourself with. You know what I mean? If you're if you're shopping, because Amazon freaks, hello. If you're ordering from Amazon every week, that's stuff you could stop doing in order
Mhm.
to save it towards your goal. So those are little things
Definitely.
that
And
people
we do have a question here. Are
are
homes
the
less expensive for 55 plus person?
no, it'll actually be more, because depending on the amount, if you're already in that age range, you and it all depends on the country where you live, because if there's no retirement age where you live, they may go to age 70 for amortization. So if you're 50 or 60, then they will take it to 70, which means you only have a 10-year term, which means your payment are going to be higher. Now,
Mhm.
what will contribute to it not being so high is if the interest rate is lower. So if you are in the United States and your rate is probably 5%, um, it could still be a little bit high though. Let me see. Let me see if I can do one right quick.
Pretty much it depends on if your country, if you where you are has a retirement age. So it depends on the term, depends on your down payment, all of those things. Where so I guess that
Yeah,
cost is
so the
relative.
Yeah, it depends on the asking price, or the net asking price. It depends on the rate you're able to get. But for sure, the amortization will only be until the age of 70. Now, people who live in the Caribbean, there is a retirement age, and that is 65. And so if you're 55 plus, your term will only be until you're at age 65, which is the expected retirement age. Now, There is an exception that we make for persons who are professionals. So, professionals are individuals that can work beyond retirement age because they can have their own firm, who are accountants, lawyers, doctors, a lot of people that fall within
Mhm.
that umbrella of professions that you need a certain level of degree and you can practice on your own and you don't have to work for someone. Those individuals can get mortgage facilities up to age 70 in the Caribbean. Okay, so there's an exception made because most of the time they have their own business already, they have a firm, and they're making substantial money, so they can afford it. And so an exception is made in that case, so they get an increased 5 years. But regular people, like some of us, regular people, we go to age 65, and that
Unless they
is
change
it.
it.
I hope
But
they
we
change it
talked
because
about, yeah,
people are
people are
younger.
young. Yeah.
It's not
Hmm.
how it used to be.
And I know we talked a lot about mortgages, but what about other
Yeah.
financing options? What if I wanted to take the route of financing with a development company? So I know when I was looking at a particular development out west, they had financing through their property management company. Are they more expensive?
Okay.
Is that advisable versus the bank?
They
More
are
expensive?
definitely more. Their rates will definitely be more expensive because the risk is very high.
Mm-hmm.
And if anybody is offering a rate more than 10% is high. Okay. And you can calculate the payments, you may be able to qualify. Some people might decide to do it that way because if they can't afford it with the bank, or for whatever reason they get declined from the bank and they have another option. If you can show where you've paid these people consistently for a year or two, you can actually
Switch
transfer
over.
the
Ah,
facility
okay.
to the bank. And of course, you still have to qualify and all that stuff, but you wouldn't have to worry about the closing costs. You'll just be transferring your facility, and the bank will just be paying them the balance, and you'll be paying the bank. Sometimes individuals have to do that even here because initially they, for whatever reason, they can't get it at the bank. They may go to another financial institution that is not a regular retail bank, and they'll have a higher rate,
Mm-hmm.
higher. And so then if they pay for a year or two and everything is fine and they're able to qualify, they can switch that facility on and get a lower rate, more affordable, more flexible terms. But businesses outside of the regular commercial banks, their fees are going to be higher. That's just like payday loans, like their rates are
Oh yeah.
significantly
Mm-hmm.
higher because they're taking on a lot of risk. Is a risk that you still may not pay, even though they put whatever in place. People know how to duck and dodge if they want to, so it's still a risk.
I know I almost got swayed by that because the payment plans look so easy and laid out, but you don't think about
Yeah,
this figure of interest. Like interest is like you have to really sit down and do the math and compare it. And there's a ton of mortgage calculators online, guys, that you can use. I played with a few this week,
free.
and it shows you like, how if you put an extra payment on top, which your payments are going to be over the course of the
Yeah,
mortgage, how much increase you decrease over the course of the loan. So definitely play with those calculators and see your options. But a practice that I heard about people doing is they take out a loan at another institution for their down
hmm
payment, and they come to your institution and they take out their full home mortgage with you. I know banks advise against that. What's the rationale for advising against that?
so the reason why the bank doesn't, well, and the Bahamas states do that a lot because a
Mm-hmm.
lot of people get in trouble with Iraq homes doing that. Okay, so a lot of people borrowed money for their down payment and then came to the bank. They had the down payment, okay, everything's fine. You qualify for the mortgage payment, you get your house. The problem comes in with the funds that you borrowed for the down payment, and those payments are
Mm-hmm.
significant. And if the bank qualified you based on your income and based on the knowledge of not knowing that this loan existed, you have now overextended yourself and cannot afford to pay both the bank and this person who lent you the money for the down payment.
Wow.
This is what happened to a lot of people. Now, the smart thing would be, is to disclose that you borrowed the money. Now, and this is only if you borrowed it outside of a financial institution, if you borrowed it from somewhere, somewhere else, because the bank has to account for that payment to ensure you're still qualifying and you're still able to afford living and paying these payments. Because at the end of the day, when you make the commitment to the bank, they're going to call you and they're going to say, you're 5 days late, you're 10 days late, 20, 50, whatever days. When are you making the payment? Because you committed to
Mm-hmm.
us that you're going to pay this for 20 years. I shouldn't have to be calling you for a payment because for the rest of your adult life you're paying this. So why am I calling you?
Yep. And then even when people doing that, they need to know when you defer a payment, you may think that
It's not good.
you get a little break, but no, you have to pay interest that's accrued over the course of that break, and that
Yes.
extends the duration of your home mortgage. So when you
Yes.
see deferrals, even these COVID deferrals, if you don't need to defer payments, if you are comfortable to pay them, even
Yes.
despite COVID going on, pay your debts. Even I know people like to
Yeah.
have BPL and water and sewage bills just floating, just like rising up and floating. Let's
I
stop that
can't.
practice. That is not.
I don't know how people do that. Honestly, like every month,
My
I
daddy
am
does that.
like,
I have to. He cringe like.
but you know what? Even like, let's say because a lot of our viewers are gonna be from the Bahamas, Turks and Caicos, and stuff like that. A lot of facilities are online. Okay, even in the Bahamas, you can pay your bills online. Why are people still waiting online to pay their bills? And then they're using that as an excuse as to why they didn't pay last month because the line was too long and this and that. Okay, but
Well,
then
some
what you're
people
doing
don't
with the
trust
money,
online payment. That's what I've heard. I don't want my
girl,
bank account details online. And you got to go with how it is.
that
But culturally, people let these bills go up, and that's a bad practice. So.
because it is culturally acceptable not to
Mhm.
pay your bills every month. So they
Mhm.
use this online thing as an excuse to say, well, oh, I don't trust online, and oh, this one, they thief their money this time. Listen, it's all excuses to just facilitate living and doing whatever.
Bad habit.
A lot of people don't like to acknowledge what they really make. A lot of people rather if the bill could run on for 2 or 3 months and they spending it on whatever else, then they're fine. And then these same people want to get a mortgage and then they're surprised when the bank tell them they can't qualify. And it's like, okay, you should know how much money you make every month. Like you should know how much your bills are every month and know how much money you have left over
Mhm.
to be able to do anything with. So why are you surprised now that when I tell you, okay, no, you can't qualify for this. This is how much you can qualify for. You know how much people are like shocked, like
Yeah.
they're looking at a $300,000 home, and then you come and tell them, well, okay, well, you only get qualified for 150.
Mhm. And the homes at 150, you don't want the homes at 150. You want to be where they are. And so that's the issue in the Bahamas for young people, where your income, you can't qualify, and people are spending and not having good financial habits. Financial literacy isn't taught in schools.
Yeah.
And then you trying to get out of certain areas or, start a new life for your family, and you find that nothing is happening for me. And so here
Hmm.
we'll talk about the initiative by the government, which I think is a good opportunity for some people. The lots are $50,000, and so that could be something that will help you if you really
Yeah.
want home ownership. That is something that
Yeah.
could be beneficial for you. But let's talk about how to put yourself in the best financial position. And you said some key points. So this is some takeaways I had from what you said, and then you can, elaborate. So you said get your bills under control, your expenses, so all your utility bills, get
Yeah.
them into a pretty much a range where you expect it to be X amount every month.
Yes.
So I have my water bill under control for 5 months. Let's even try for a year, because
Yeah.
let's say during this time you're saving towards your down payment and stuff. In the summertime, I see what it's like. In the wintertime, I see what it's like, and I have it in a certain range. Same for all your bills. So you have consistency. You know what's going out. And so also you paying down debt that you don't need. If I don't need this credit card bill, if I should rather be paying for stuff for cash for this year onwards, let me start moving to cash payments or pay off my credit card right away. Let me not carry debt. If I have debt with Furniture Plus, if I have debt with this payday loan, let me pay all of that off. And then I'm saving not only for, I'm calculating that 45% or the 30%, see what I can
Mhm.
afford before I go to the bank and ask them to do anything for me. And then I'm not only saving the 20% down payment, I'm trying to save towards double that before
Right.
I get to the bank. So is there anything else me as a person who wants to purchase a home should do to prepare myself for this home purchase? Not just for a pre-approval, but just a mortgage, period. Having a mortgage on my back, period.
Yeah, I think that what a lot of people don't think about is after. So everything is always focused on purchase. I need to
Mm-hmm.
buy this.
Mm-hmm.
But a lot of people don't think about what happens after you own a home. Like
Yeah.
you are ultimately responsible for your home. It's not like when you're renting and you could call the landlord if the pipe bursts or this needs a paint or whatever. You are ultimately responsible and you're responsible for the upkeep. So now the thing after you get the mortgage is, how do I afford to upkeep my home? How do I afford to maintain the
Yep, that's it.
integrity of this building, because the bank is holding it as collateral? It doesn't maintain the same value. It's expected that the value would increase based on development in your area, based on how you take care of the home. But a lot of people move in or purchase a home and do nothing. You never paint, you never fix anything that's broken. It's just deteriorating. And then it gets to a point where, okay, if you're having problems meeting the payment, when the bank now has to assess this home, it's no longer even value what it originally was, or that they're holding it for. And it makes it difficult to even recover the cost of the home because you did not maintain the home. This is now your responsibility.
Yeah,
The home is an ongoing cost. You
yeah.
have to maintain the home. You have to maintain the insurance on the home if there's a hurricane or anything like that.
Hurricane, flood, fire.
You have to
And these
maintain these
days,
things.
you can't only do hurricane insurance. You gotta do flood
But
insurance too, because there's some crazy stuff happening.
it's
Fire, all of these things, you have to consider it. You have to consider
yes.
theft and
Oh,
protecting your assets, because this is your asset. This is your asset and you need to protect it. The better you do
yes,
with that, if when it's time to sell it, you can get a premium dollar. We had people on
exactly.
last week. They were able to, two women, they were able to sell their home for double. And you only could do that if you invest properly into your home.
Exactly. And you
So
take
my
care
final,
of it
go ahead,
because
sorry.
you
Yeah.
you may decide that you no longer want to live in that area, or you find something else that you like. If you've been maintaining the home, you can get a sale, a substantial amount, like that they've shown that they've been able to increase the value of the home since they've been living there. You're able to make a profit, and now you're able to inject that into your next project. And like I said, if you have something on a property, like over here in the Turks and Caicos, a lot of people have guest homes. And while it's a guest home in case family comes over, realistically, that is a money maker. That is an apartment, that is a mini home
Hmm.
that can pay for your mortgage. And so, if you have a guest home on your property, you can rent that out. That can be able to maintain the property and all of these other things. You should always be focused on income coming in.
And long term
uh,
too, yeah.
Producing property is always going to benefit you more than just having a house and sitting up in it and you cannot afford to maintain it, because getting in the door is one thing, but you have to maintain it.
If you have any questions, now is the time to ask. I have literally one more question. So we talked
Okay.
about home financing options. We talked about the mortgage. We talked about if you go into the development company. The last one that I
Uh-huh.
hear people doing is paying out of pocket. Do you have
Okay.
any advice for people taking this approach? Maybe or one of our guests, she was able to take out a mortgage for her property itself, but she found
Yes.
difficulty in terms of the construction of the home, and she decided to bail out of pocket. So, any advice for people taking that route? Should they borrow a small amount to say cover like a bulk purchase, like, or should they? How should they do this thing?
The thing is, it's like tomato. It's the same thing in terms
Yeah.
of it's going to be a high
Hmm.
cost. So I've found that construction is only beneficial if you have access to cash every month that you can that can make a substantial dent into what you're doing. Because if you get, let's say, if you purchase a property and now you want to convert it into a construction loan, the problem now, and of course, this is the innocent suffering for the guilty, the banks now
Mm-hmm.
want you to pay upfront. So basically, you start phase one. Phase one is completed, it's appraised, it's confirmed that everything is done in phase one, then the bank reimburses you. Okay? That means you have that money. Phase two, you have to complete phase two, confirm that it's completed by the appraiser, not word of mouth or whatever. The appraiser has to come and
That's another
reevaluate it,
$800.
and
Wow.
then you get the money for phase two. Phase three, you have to continue on with phase three. You get the money after it's confirmed again. And then
Mm,
phase four, you complete the home. And so you get the money after the fact. So the bank is ensuring that you're not only completing it, but it's being done to the standards that will make it acceptable collateral. That's if you get a construction loan. It's very costly
mm,
because things go wrong. And I find that a lot of people never stick to the plan and they always find themselves in a jam or falling out with their contractor or changing contractor, this thing and that thing, and you have your cousin billing for you, y'all follow. Now you need a new contractor. And then that's why the bank says now you need to have 10% of your total cost of construction on an account on hold. So in the event that you need extra funds or you change contractors or you can't qualify for more money, there's actual money there to help you to complete the project. So there's
wow.
a lot of things in place because a lot of things that happen over the years now, in hindsight, makes it difficult for both the bank and the person who's completing the construction. Now, if you have access to family members that do good construction and you can just buy your materials and build like that, it's always advisable to start your construction. And when you get to a certain point, maybe the third or fourth stage, then you can probably go to the bank and seek financing because it's not going to cost so much. And then you will have already gone through most of the work. So they'll just be financing the last final phases of the construction. And then, it will be much more easier for you. But people
Mm,
who do
okay.
that upfront construction, they have the money to do that. And they're just, or the construction company has the money. So if the construction company has the funds to facilitate, they're paid back once everything is gone through the process. So it all depends on who you select to build your home. So if you go
Mhm.
with a company that has the money to mobilize, you can get it done. But if you choose a contractor that might cost a little bit less, you're going to have all of the money in order to construct. So
That's a
those are,
great thing to consider for sure in that process. So, it sounds like building out of pocket. If you can accommodate that, I mean, the lady we spoke to, she took on
mhm,
multiple extra jobs in order to make those payments.
yes, because
And so, if you're
realistically,
willing to sacrifice, you can. Yeah.
and you still have to have that extra money and you need at least 2,000 or more to really build a lot of purchase a lot of materials to be able to then start building. So
Yeah. So it's the biggest investment you'll ever make in your whole life. If you're single, don't waste a ton of money on your wedding because you have all of these expenses coming up. Make sure you budget every single dollar for your wedding and work within that and plan for the long term. Plan
yeah,
for the long term. And I love that you put that on the screen that if you save, I think it was a little over $1,600 a month, every month, you could have $20,000 a year. If you save that for 5 years, you could have
that's
$100,000. If you have that discipline to be able to do that,
yeah,
that could set you up so well when it comes down to I want to purchase my home. A lot of
yeah,
people have these goals. I want to get in my home by 30. Why? You want to put yourself in a dead hole so you lose
exactly.
your home at 32? You
Exactly.
know, do it when you can afford to do it. And if you want to be in your home by 30, purchase a smaller property, flip it, or rent it out, but be wise. So
Yes,
that's my takeaways. And we have more. Next week, we're talking about the real deal about owning your home with a few couples. But Arlene,
yeah,
thank you so much for tonight.
thank
Your
you.
wisdom is just top notch, the way you explain, and I just love it. And so I know even you transition into anti-money laundering, you do a lot of teaching there as well. I'm sure that serves you well. But let our viewers know where they can reach you. I'm sure they're gonna have questions that they may have not wanted to ask publicly. So where can they follow you?
Okay, so you can follow me on Instagram at All In with Arlene. And I think Zami's going to put that up on the screen. So that's All In with Arlene for any financial questions that you may have. That is my page that I have dedicated towards any other questions outside of beauty, my beauty pages. So All In with Arlene is where you can contact me via DM and I'll be able to answer whatever questions you may have. Or if you know me personally, you can reach out to me through whatever avenue that you have for me. But I will be happy to answer whatever questions you may have. I do have a lot of knowledge and I am very passionate about sharing that with people because I find that people are disappointed a lot of times when they go to the bank, and it's not solely the bank's fault, but your lack of research and stuff, things that you should know about yourself and being prepared before you contact the bank. Okay.
Exactly. Thank you. And then we have one of our guests. She said, "Thank you. This was very informative." I think this was your
Yes.
aunt. So thank you, Auntie, for joining us again. We appreciate you. It definitely was informative. I guess you guys walked away with a ton of wisdom. And I'll see you next week. Oh, one more comment before we go. This was lots of great info. Thank you guys. No problem. And we actually have Chana is our singles outreach officer, and she has an event coming up on Friday for singles. It's called Her Season, and the topic is understanding. No, tell me. The topic is, I think it's dealing with the uncomfortable.
Oh,
It's dealing
okay.
with the uncomfortable. So all of those questions that singles get: when are you gonna get married? When are you gonna have kids? Your clock running out. It's really about that. So definitely, if you want to tune into that.
Oh,
So
also,
that's it. Oh, go ahead.
okay.
Hmm.
Just a quick plug for our previous video for some, if
Yes.
you have some questions that you don't think were answered here, we did our first session and that I explains a lot of terms and a lot of information that you may want to know, before you view this video again or whatever. You can go back to that first video and I think Zami's gonna put that in the description when it's uploaded so that you could access
Yes.
that
And I'm
with the
going
information.
to wherever I'm pointing. It's gonna be on wherever I'm pointing. I don't know where it's gonna be, but I'm gonna put a link up here somewhere. Okay, everyone, have a blessed night. Thank you again, and I'll see you soon. Bye.
Bye.